May's headline personal consumption expenditure came in 4.1% year-on-year. It's the highest since 3 years ago. And when we look at the core figure, removing food and energy prices and preferred by Fed, it came in 3.4% year-on-year. The markets feel that the core figure only grew a 0.3% month-on-month, and with the Middle East war somewhat coming to an end soon, the stock market futures remain in positive territory. But still, traders expect the Fed to increase interest rate in September, but they cut the odds of it happening to 61.6%. With inflation at a 3-year high, consumers are spending more on gas, healthcare, and utilities. New Fed Chair Kevin Warsh stressed the importance of price stability and indicated the likelihood of an interest rate hike this year. And other than the effects of Middle East war that pushed prices higher, markets are also concerned about the Trump's tariffs. UK voted for Brexit in 23 June 2016, and it's been 10 years. The move was finalized by one of the former prime ministers, Boris Johnson, in 2020. The Brexit campaign promised to take control of immigration and free up more money to the country's health service and forge better trade deals with the rest of the world. However, the economy has largely failed to experience a post-Brexit boost. Since the referendum, no prime minister lasted longer than 3 years, and the shortest is 49 days. While COVID in 2020 and Russia's invasion of Ukraine in 2022 both hit everyone globally, but Brexit has a very significant impact on UK's economy. Stanford professor Nicholas Bloom stated that Brexit reduced UK's GDP by 6% to 8% by 2025. It's due to a combination of reduced global demand, diverted management, and misallocation of resources for the very lengthy Brexit process. While they managed to take control of migration policy, but there's unintended consequences. UK ended up with more non-EU states migration, an increase in international students, and emergency visa schemes extended to countries like Ukraine. On the other hand, fewer Europeans are moving to the UK. If you research deeper, in the UK, people are working harder but receiving lower salary. The currency weakness is a clear indicator of the impact of Brexit. British pound crashed after the vote, and yet to regain to pre-Brexit highs against both euro and the US dollar. Against euro, British pound averaged about 1.16 since the referendum. It's down from 1.27 the decade before, and it has been trading 98% of the time below 1.2 since Brexit. The impact made foreign goods and assets immediately more expensive for UK citizens, and hence affecting the cost of living. And UK is a significant importer of food, energy, and materials. After being a standalone out of European Union, EU still remains as UK's largest trading partner. The EU accounted for 41% of UK's exports and 50% of UK's imports. Even though a new trade deal between the two parties was signed on January 2021, preventing either side from introducing tariffs or quotas, but because of Brexit, exporting to EU market is more expensive and harder. It also doesn't help that UK didn't build enough new, non-EU goods exports demand to compensate for the more friction to trade between them and EU. This hurts goods more than services, especially the small exporters. The UK stock market still bears the scars from Brexit, and that weighed on both businesses and investors' confidence. Let's look at two key UK stock market indexes. The FTSE 100, which focuses on the big, global, multinational corporations, and the FTSE 250, which focuses on the domestic players. FTSE 100 outperforms the domestic-focused FTSE 250. This shows that the domestic companies are struggling ever since Brexit. Currency weakness, currency-led inflation, especially when importing, and the high cost of capital are the main reasons. Recently, the UK government bond yields are at very high levels, and that pushed loans pricing upwards. And then, neither of the two indexes are experiencing gains like the US equity market. None are fueled by technology and AI stocks. This is a big difference between most of the European companies against US companies in China, and also UK stock market has little changed since 10 years ago. Let's talk about China. Officials recently commented on reducing US dollar dependence again. This is nothing new. Recently, the officials announced measures to create a stronger infrastructure that allows countries to operate outside of the dollar-based system. China wants to deepen Shanghai's role as international financial center, improve cross-border renminbi trading, and announce 6 measures. The important ones are renminbi clearing, which is linked to payment systems, better liquidity for Chinese capital markets, and making renminbi usage more practical for trade, investment, reserves, and liquidity management. And China wants to reduce its vulnerability to US sanctions. But they're not trying to replace the dollar. There's no need to replace the dollar with renminbi. Even a partial alternate system can reduce the world's reliance on dollar-based channels. For some background, China first. China has been trying to internationalize renminbi since 2008 financial crisis, but they rarely rely on one sudden reform. Their method is to build capacity slowly, running tests, and eventually reach the end goal. And some background on the US dollar's dominance. For example, if Company A in Asia wants to buy oil from Company B in Middle East, look at the icons and diagram at the right. Most of the time, the invoice will be in US dollar. Because of that, the dollar clearing often touches a US-regulated institutions or clearing system platform. When the Asian company pays the Middle East company, the US correspondent bank or clearing platform will be in the middle. Therefore, the US can stop the payment processing if any of the parties is sanctioned. That's how sanction works and how much power the US has. They don't need to physically stop the shipment of the oil. They can just make the payment very difficult. Here's some obvious impact when the renminbi is more internationalized. Countries can settle trades, hold reserves, and access more liquidity outside of US dollar, and US sanctions will be less powerful. Next, global investors will also see more opportunities in Chinese bonds and more liquidity in China and Shanghai financial channels. But that still remains dependent on the Chinese government rules and regulations and strategic priorities. Lastly, for geopolitics, countries, even some US allies, can then view the renminbi infrastructure as a hedge, providing more options outside of the US-centric system. A quick update. Over the weekend, U.S. and Iran exchanged attacks again, but eventually paused, and commercial vessels are still transiting the Strait of Hormuz freely. The two are in the middle of the 60-day ceasefire negotiation period. Let's link today's topics to 4 equities with high gains. This is just a link to the market, not a buying guide. The equity names don't matter, but more so to see the link to the respective industries and how global trends support certain industries. First, Micron has a $22 billion commitment from customer. This shows that despite high inflation, the strong AI demand is still powerful enough to outweigh the inflation level and rate hike anxiety. This is one good example that global trends support semiconductor. Next, on the renminbi infrastructure part, Orient Securities recently had a deal with Shanghai Securities. This is a link to China's push to build a larger and more competitive domestic financial landscape. Third, we mentioned FTSE 100. The one that is global focused performs better than the domestic players because of the challenging landscape in UK that makes domestic players tougher to excel. Rolls-Royce is one of the prominent constituents of FTSE 100 with strong global outreach, and UK equity leadership often comes from international earners and not the domestic players. Lastly, airlines. Crude recently retreated, and that means lower jet fuel costs.